Resurgent India Knowledge Series presents a virtual session on Unveiling the Emerging Landscape in MA. Moderator Mr. Ashish Agrawal, Director, Resurgent India Limited. Chartered Accountant Management graduate Ashish Agrawal has a rich experience of more than 25 years in financial sector. He has an extensive knowledge in credit investment banking, corporate finance, capital market operations, foreign exchange services, debt syndication, wealth management, and financial advisory services. Agrawal has successfully sourced and executed over 100 assignments for debt, equity, M&A across various sectors, streamlined improved existing systems processes, risk mitigation, identified process improvements, control gaps, transition developed procedures, and service standards for business excellence. Eminent speakers Mr. Vikas Duggar, Head Corporate Venture Capital Global M&A, Cipla. Vikas Duggar is the Head of Corporate VC and MA at Cipla Limited. He leads the acquisition of pharma and consumer companies by Cipla globally and minority investments into the wider healthcare ecosystem. He has more than 19 years of experience in private equity investing and corporate finance. Prior to joining Cipla, he was a senior member of the investment team at Investco Private Equity and has led several investments into healthcare, consumer, e-commerce and retail space with multi-bagger returns from multiple such investments. He is a chartered accountant and a MBA from IIM Bangalore. Mr. Vikas Aggarwal, Head M&A, Infra. Market. Experienced acquisition specialist with a demonstrated history of working in the building materials industry, skilled in analytical skills, corporate development, mergers acquisitions, MA and structured finance. Strong business development professional with MBA, Finance, from IBS Hyderabad. He has nearly 20 years of experience into MA and fundraise. Currently he is Head MA at Infra. Market, covering strategy, acquisitions partnerships. Mr. Vishnu Acharya, Head of Corporate Development, M&A and Investments, Razorpay. Vishnu Acharya is a highly accomplished leader who currently serves as the Head of Strategy Corporate Development, MA Investments, at Razorpay. He has been responsible for the group's strategy, growth, inorganic, organic, and identifying investing in new companies that contribute to significant potential for Razorpay. He has been playing a critical role in driving the financial and operational growth of the company and also manages international expansion strategy. Vishnu is also a partner investor at Mars Short Ventures, an angel fund started by the Razorpay founders himself co-team. Mars Short has invested in 40+ companies across sectors. He is also a venture advisor to SeedStars, a global VC fund. Advocate M.M. Sharma, Head Competition Law Practice, Weish Associates Advocates. Mr. M.M. Sharma, Advocate, Delhi High Court, D6061985, heads the competition law policy practice in the law firm, Weish Associates Advocates, WA, since 2009. WA is a 52-year-old reputed tax, corporate and business advisory law firm with offices in Delhi, Mumbai and Bangalore. He has over 38 years experience, including regulatory judicial experience as judge advocate, Jug Branch, in the Indian Navy Coast Guard of over 10 years. He holds a postgraduate diploma in economics of competition law from King's College, London. He has worked in the Competition Commission of India, CCI, as additional registrar during 2006-2008 and was responsible for drafting the implementing regulations under the Competition Act, 2002. He also worked as head legal in-house counsel in Jindal Steel and Power Limited, JSPL, before joining WA.
Good evening, friends. I'm Ashish Agrawal, Director of Resurgent India Limited. I would like to welcome to all of you in this today's webinar on the very important topic called Unveiling the Emerging Landscape in M&A. So as Resurgent India Limited, we have hosted almost 210 webinars in last 3.5 years on various topics where more than 2 lakh participants have joined from different regions, and they have taken the advantage and benefits of the webinars, and they are more knowledgeable now. So in this series, we are organizing this 211th webinar, mainly on M&A side. We have speakers, the panelists. Those are well experienced. They are practicing M&A since last many years in their journey, in their career. And we have very good panel from the industry. So we have panel from the pharma industry. Then we have the panel from the startup, diversified startup company. Then we have the leading pharma fintech company M&A head. And then we have a lawyer, because any M&A cannot be completed without the lawyer's help. And competition commission is one of the I think major area where they are playing an important role for any kind of M&A. There is need of after certain threshold, there is need of competition commission approval also. So we will discuss all these aspects. We will understand from these leading experts from their point of view, what is the current landscape in M&A, and how the India is emerging, not on Indian domestic M&A, but in the global M&A space also. So India is corporates now becoming global. So they are becoming MNCs from India. So they are doing a lot of international global M&As also. So there are many opportunities also there in M&A space. There are many challenges are there. As you know that India is growing like anything. So there are two ways of growing any business. Either you do organic growth, where you have to set up your business from the scratch and wait for certain years, and then you have to reach to a certain stage. Or you can go for the companies which are available at the reasonable cost, and you can buy out these companies, and you can merge these companies, and then you can grow fast also. So we will discuss today on the merger acquisition side, and I'm very happy to be here with all of you. I will request you to please make it more interactive. You can ask any question. You can write in the chat box. I will be happy to take these questions at the end of the webinar, and our experts will be happy to give the answer of these questions. If any questions will remain unanswered, we will try to send you the answer through the email. So once again, I would like to welcome to all of you in this webinar. I've prepared a small PPT, which I would like to just run through so that I can set the context, what is happening globally, what is happening in India, and what are the challenges and opportunities in the M&A space. So I request to my team to please run through that PPT. So Rohan, can you just take out this PPT? Good. So friends, if you see the trend in the M&A space in the last year, so it's a declining trend globally. If you see there is a drop of something around 15% in the overall size of M&A, which is the lowest in the decade. So I think that's a worry that why the declining trend is there. If we see in last 20 years, this 2021 was the highest number of highest in the valuation, in the value term in the M&A space. So there are reasons for that. If we see the higher interest rate, geographical, I think challenges also, this some kind of regulatory tightness also, this can be the main concern also, and the microeconomic signals. So we hope that this current year, as the US Fed also has given the indication that rates will not increase, so it may go down. It might help to grow the number of M&As also. And if we see the strategic M&A side globally, again, it is also on the lower side from 66%. So the numbers are not very attractive in the year 2023, but there are basically reasons for that. Basically, the valuation gap, maybe the biggest reason for that, which might be helpful in this the current year 2024. And as I told you, the interest rates and other things are also impacting the overall deal flow or the overall M&A volume also. Next. The next slide. Can you go on the next slide? Yeah, thank you. So, friend, if we see from the Indian point of view, India also is not a good number. Again, globally, we are down something around 15%. But if we see the India point of view, we are down something around 63% in terms of our volume, value-wise M&A in India actually, which is I think really a concern for all of us. And we see there are regions for that. Maybe the again the interest rates and the whatever the valuations which were not matching as per the requirement. And we see the overall M&A last year, this in mid market, I think it's taking up the shape where almost 50% of the M&A were done in the mid market, where the valuation, where the revenue of these companies is up to $1 billion actually. So these companies which are up to $1 billion revenue are coming up in this space, and they are taking up the some kind of big number. And if we see again, these numbers are basically the numbers are lowest in the last 10 years. But we hope that this current year 2024 will be better than the last year. Next slide. So in India, almost I think 300 to 400 deals are happening every year. Where the startup space is also taking up the great space. One third of that is taken up by the startup companies in the M&A space. If we see the last year top 10 deals, so the major deals were done in the healthcare sector. Out of 10 deals, if we see that almost 5, 6 deals are from the healthcare sectors, healthcare and pharma sector, and then the consumer sector took the lead. And there are 2 deals from the BFSI sector actually. And the largest deal was HDFC Limited in the BFSI sector. So if you see the trend, I think healthcare and pharma is taking the lead in the overall M&A space, and then the consumer and the fintech space actually. Next slide. Yeah, next slide. So we see the future, this 2024, we see that the whatever the deals which could not be done in 2023 because of certain regions. So I think there can be some deal pile up, which will be possible in this year. So this number will increase. That can be one of the region. And there are many private equity funds, those are buyout fund, or they are having the aged portfolio. They're also looking to exit by way of IPO market or through the M&A market actually. So I hope that there'll be some deals which will come in the market from that side also. And we see the other things. I think in M&A, the competition is coming also. So this, I think speed and conviction, these 2 things are very, very important. So for M&A deal, it is very important for the advisors or for the company, those are this process. They have to have the speed in that transactions, which will help them to close it as fast as possible. And we see in India, there are a lot of surplus cash is there in the balance sheet of the corporates. So this is a good sign that and the country is also doing well, and we hope that the next government will also support it. So there'll be utilization of this cash by way of inorganic growth. So there can be more deals in the coming years, and the interest rate cycle also, although it is not on the declining trend, but it is at least on hold. So hopefully in the second half of the year, it will be on the declining trend. Then this will also help to get the more M&A in the system actually. And so we hope that these things will help. Next slide. Yeah, next slide. So how we can manage risk in the M&A? So there are various challenges which are coming whenever any M&A transaction is there. So one thing is that the due diligence, where we have to see the how what are the hidden liabilities, and the ESG is one of the area where most of the corporates are very having very big concern on the ESG side. So these things should be taken care well before doing any M&A, and the advisors or the lawyers or the accounting firm, they should have the understanding of these areas, and they should taken up very well during the M&A transactions. This will help to mitigate the risk of the future risk in case of any M&A. Then we have to see the warranties and the representative representations. So this we need to ensure that the proper warranties have been covered regarding the financial statements or intellectual property, the environment related issues, which should be covered well in advance. So these are some of the points basically for the people who are engaged in M&A that they should kept in mind. Then the security of the deal basically. So we have to see that the escrow mechanism can help basically, and these are the areas which scattered payment also. So any failure or any challenge during the deal, it can be covered from that. This can be another area. Then the integration challenges I've seen in many cases, there are cultural issues are there, integration challenges are there, which should be addressed before going the deal, so that it should be known in advance that what kind of challenges can be there. And then we have there are many times the deal got dropped because of unfavorable conditions. So the M&A advisors and the people who are engaged in that, they should see that the deal should not be accepted only because of that you want to do the deal. Whatever the unfavorable conditions are there, it should be taken care well in advance, so that there should not be any issue in the future. Manage employee communication. I think this is a well-known fact. Whatever the employees are there, they should be taken care of well, or their communication should be done with the employees, so that there should be not be any disruption regarding talent loss in future actually. Then the expert guidance. So there are many sector experts are there. So whenever any deal is happening in the M&A, then I think other than the accounting firm or legal advisors and the investment banker, there can be discussions or the guidance from the technocrats or the other experts. It can help to close the deal faster, and I think whatever the future challenges are, which can be reduced also. Next slide. Yeah, next slide. So thank you very much. I think this is all from our side regarding our understanding. So the idea was just to give you some brief background, what is happening in India and what is happening across the world in the M&A space. And now we have a very good panel. So I would like to invite our panel for their deliberation, and they are the people who are practicing this M&A on daily basis. So I would like to invite Mr. Vikas Agarwal, who is head M&A infra market, and Mr. Vikas has wide experience on both the sides. So he was the banker for on M&A side for many years, and now he's heading the M&A in a startup diversified corporate. So first of all, Vikasji, I would like to welcome you and thank you for joining with us in this webinar. And we will be happy to know from you, Vikasji, your journey in terms of this infra market. How basically, as a startup, you are engaging in the M&A transactions, or what kind of opportunities you have already grabbed, and what kind of opportunity you are looking for, and what is your outlook for the M&A in India. Then we would like to have some more questions from you. So welcome to you, and over to you, Vikasji.
Thank you, Ashish.
Yeah.
So going back on the infra market, we started way back in 2016. Of course, we started as a typical B2B play. The idea at that time was to purely look at opportunities wherever there are surplus capacities at the manufacturer level and go to the customers, which are basically the EPC and RE customers. Of course, since then, we've kind of extended the business from B2B to B2C, and now even beyond B2B, B2C to manufacturing. So now, as we speak, we are kind of end-to-end play within the entire building construction material range. In terms of the product categories, we are there from ready-mix concrete, AAC blocks, PVC pipe, construction chemicals, aggregate, wood panels, which is basically ply, MDF, to electrical products, to tiles, sanitary wares, bathware, modular kitchen, and paints. The idea from our perspective at Infra Market is to be a kind of a one-stop solution provider for the entire building material construction range. That's what we intend to be. In short form, we intend to be kind of a construction material for Amazon. Though India as a market will take some time to reach as a .com purchase. So right now the entire energy and efforts is to kind of integrate the distribution channel, which is at the retailer distribution level. And then, of course, we brought a tech layer on top of it. In terms of inorganic, growth, we've done a couple of initiatives. We acquired a ready-mix concrete company called as RDC Concrete from True North, taken a strategic position in Shalimar Paints, and would have done a couple of asset level acquisitions in tiles, AAC blocks, wood panel, electrical, and all. But from our perspective, the idea remains is that anything and everything to do with building material, and purely as a material play, what we are looking at. Ashish, over to you.
Thank you, Vikasji, for giving the perspective from your point of view, your company point of view, and you've already done M&A. So you are believing in the inorganic growth kind of environment also. So thank you so much, and being a startup, and you are doing acquisitions in the hardcore space also. So that's good. We'll come to you again for the other questions. Now I would like to invite Vikas Dugarji. Vikasji, welcome to you, and thank you very much for joining with us in this webinar. And so Vikasji, again, he was on the investment side, and now he's the corporate leading M&A practice and the investment practice also. And he's working with a large giant Cipla, so it's a well-known name, and they have done many transactions also. So Vikasji, I would like to understand I think your organization acquisitions goals and strategies, and which are the preferred sector, sub-sector where you would be keen to do the inorganic growth also. And what are the ingredients which generally you see when you are doing any acquisition or any merger in your company? Over to you, and thank you very much for joining with us.
Thank you, Ashish, and thanks to the entire Resurgent India team for inviting me. And it's a privilege to be part of this group, learning from the other panelists. Maybe I'll talk first about Cipla. Cipla as a brand is known to everyone. Now it's a 89-year-old company, kind of run by the third generation founders. And today it is fully professionally run by the management team. Very little involvement of the promoters, only in very high level strategic kind of directions. Cipla today, third largest pharma company in India, third largest in South Africa, close to $1 billion business in US built over the last 5-6 years, and direct presence in UK and Spain, indirect presence in other parts of Europe, Australia. So the business is fairly spread out throughout the globe, and we are very strong in some of the key therapeutic areas, largely in respiratory. in the asthma segment. We are the second largest producer of asthma drugs globally after GSK, and in terms of volume. And we also have a big focus on consumer OTC brands. So we have a subsidiary, Cipla Health, which is now today more than 1,200 crore business, selling OTC brands, Nicotex and Cupcell. Cupcell is today larger than Strepsil, and Omnigel. Some of these brands are their Cipla brands, and we are kind of adding more there through acquisitions, through organic growth. Uh, India, we have more than 25 manufacturing facilities, largely on the formulation side as well as some on the API side. Today, roughly around $13.5 billion market cap. Last year was around 26,000 crores of revenue, roughly EBITDA margins which are in the mid-20s. On the M&A side, I would say that if I look at the space, the general pharma space in India, everyone is wanting to do M&A. I can talk about at least the larger pharma companies. But the key reason for everyone looking at M&A is that pharma is a fairly cash generative business. Everyone, almost, I would say top 10, top 20 pharma companies, they are sitting on cash actually. Cipla itself has today more than 7,200 crores of net cash on the balance sheet, adding kind of 1,000 crores of PAT every quarter. So that's the kind of cash pile which Cipla has, and every other pharma company has, not only Cipla. And the space, the Indian pharma market is growing at some 10-11%, and everyone, or the larger pharma companies, want to grow faster than that. And that's where most of them are looking at acquiring things so that they can grow faster than the market, become larger. The other piece is for other reason for Cipla or likes of Cipla to look for M&A is to fill gaps in their portfolio. Cipla today in the respiratory side is a quarter market share, roughly around 24-25%. The next guy within respiratory, Lupin, is single-digit market share. So there is a big gap. And if you look at other therapeutic areas, Cipla may not be that strong. They may be 7th, 8th, even 10th in other areas. So the idea is that because you have a setup, you have a strong kind of marketing network, sales force, you're reaching every doctor in the country almost. Why not add to your portfolio and kind of become strong in many other areas where you have gaps in your portfolio? And that's where Cipla looks for M&A, and other pharma companies also look for M&A. And so that is for India pharma play. And then there are, as I spoke about, the consumer business which we have, where we kind of keep looking for M&A targets in the OTC space where brands have been built. So our idea is that we acquire a brand which is already there, which has been built by the founder up to an extent. We grow it with our network, our reach. Beyond India, we are very active in looking at targets in Europe, South Africa, and US. And there the idea is to have a marketing infrastructure basically on the ground, so that we can become, or we can build a larger kind of revenue traction in some of these markets. Sometimes we also look at M&A on the manufacturing side, where we look for very specialized manufacturing capabilities, largely I would say high-end oral solids or kind of injectables. So some of these are again filling the portfolio where you don't have capabilities. So that's broadly our kind of thesis on various businesses when we look for M&A.
Yeah, thank you, Vikasji. Very well said. Like all pharma companies are having a lot of surplus in the balance sheet. So they are looking for organic and inorganic. And thank you for giving the perspective of your company from the M&A point of view. Friends, now we have Mr. Vishnu Acharya. Vishnu Acharya is Mr. Acharya is basically also a well-known personality in the corporate segment. and he's heading the M&A and investments in Razorpay. Razorpay again is a giant in fintech space, financial services space, and they are working on various fronts. So welcome to Mr. Vishnu Acharya in this webinar, and thank you very much for joining with us. So, Mr. Acharya, I think we would like to understand again from you your thought process, your company thought process about the M&A space, and how you would like to grow basically organically or inorganically, which you like to understand also. And your thought on the fintech financial services space, because we see there are many things which have happened in the last year. So if you can cover on that, that will be good also. So over to you, and thank you so much.
Yeah, thanks for having me. Kind of happy to be on the panel and have the interaction. So quickly talking about fintech to begin with, right? And then maybe a little bit about Razorpay and then, how we think of inorganic. Look, I think, if you think of the next decade, I think financial services at the end of the day is still one of the largest contributors to our public markets, right? And to generally any country's economy. So I think we still have a long way to go in terms of how financial services gets revolutionized in terms of application of technology to a variety of value chains of financial services, right? Whether it's manufacturing of products, think insurance, lending, payments, or distribution online or via agents offline, etc. There's a lot of disruption. I think all of that is where fintech is going to really happen, right? That's where I think fintech thrives. Over the last, I would say 10 years, I think we've come a long way. And I would say the last 1 year has been a bit of a blip because I think a variety of reasons, I think you covered it, so I won't get into it. But for a variety of reasons, I think, in terms of valuation multiples that have been dropped, a lot of companies that got funded, probably, in categories that were not as large or established. And we're seeing some of that, play out. But I think, again, like you had shown in one of your slides, right, most of these things are a little bit cyclical. So overall, quite excited about how fintech and financial services is going to play out over the next few years. Largely, fintech has a lot, right? There is typically, banking, insurance, payments, lending, and then you can cut it up between B2B kind of companies and B2C companies, and they operate a little differently basis where they play. Razorpay itself is a B2B company. We purely service businesses, and our vision is to help businesses manage their finances and automate their finances. While we started with payments, online payments, we've expanded to offline payments, neo-banking as we call it, which means any business that has to manage their fund flows, right? So receiving money from its customers, making payments to their vendors, partners, suppliers, paying salary to their employees, which is payroll, and then getting access to credit via, let's say, credit cards or loans. We facilitate all of this on our platform across various applications, and we try to automate as much as possible to make lives of these businesses easy from a financial services perspective. So that's really the goal of Razorpay. We've been around about just about 10 years now, headquartered in Bangalore, but most of our team sits all across India and a little bit outside as well. We process about $120 billion of volume, so one of the largest in India in terms of digital payments. And we've seen India's vibrant story in terms of how UPI is picked up, and I think globally we've really put ourselves on the map in terms of our advancement in technology as well. It's sometimes even a lot more than developed markets like US and Europe. And Razorpay has driven a lot of the tech and product innovation on some of those fronts. And as we've expanded into some of the other categories beyond payments, we have taken an inorganic lens. So till date, we've actually done about 6-7 acquisitions, 6-7 investments, and a few more smaller deals, north of about $200 billion. And all of this has actually been just in the last 3 years, because that's when we started doing M&A, given we're a recent company, we're a young company. About 2 years back, we also actually expanded outside India. So we've acquired a company in Malaysia, expanded to Singapore, Dubai, and hopefully a couple of other countries as well. And some of those times we think of M&A. So that's a bit about Razorpay itself. Typically, the way we look at using capital creatively is if there is any new category that we want to enter into within India, or let's say if it's a new geography, we typically think of what's the capabilities required. And if those capabilities have already been built out in the market by a different set of founders or company, we'll think of acquiring them in terms of speed to market, right? So that's largely been the thesis of our acquisitions across most of the ones we've done, which are smaller or larger. And obviously, in some cases, there is scale acquisitions and acquisition front or behind where we sit in our value chain. So that's a bit about how we think of M&A. We've also done investments. We take minority positions in some companies where we partner with them closely and sometimes commercially to see how we can, support each other. So yeah, that's a little bit about how we think of M&A. Hopefully, we see a lot more happening in fintech, and we'll hopefully do our bit as well in the next decade. So that's from my side,
Thank
Ashish.
you. Thank you so much, Mr. Vishnu. I think you are very well covered, and you are not looking domestically, you are looking globally. The inorganic opportunity. Already you have done many also. So, friends, we have Mr. M.M. Sharma, Advocate M.M. Sharma. He is having very vast experience on the law side, actually, and then he was part of the Competition Commission of India. So he has dealt with on many large M&A in the country. So first of all, Mr. Sharma, welcome to you, and thank you very much for joining with us. I think we would be happy to know from you the role of Competition Commission in the M&A space and your experience. So if you can guide us, what should be the area where the Competition Commission is coming in the picture, and because we have all the corporates, so they would be happy to understand your views and the guidance from you also. And over to you, Mr. Sharma.
Thank you, Mr. Agarwal. I'm indeed privileged to be a part of this panel. And am I audible?
Sir, yeah, sir, you are audible. Sir, you are audible.
All right.
Yeah, you are audible.
You. Okay. After that, you so a little bit about myself and my firm. So I'm a part of VAS Associate, which is about a 50-year-old law firm. We are a large size corporate.
Your voice is not audible here. You have to unmute yourself.
No, sir, we are listening to you, sir.
We can hear you, actually. We can hear you pretty well.
Yeah, we can hear you, sir.
I think some of you may have known about VAS Associate. We are a 50-year-old law firm, and we are a corporate and direct tax and indirect tax and IPR also. And I had the competition law practice in this firm. And you see, VAS Associate is the USPs that we have chartered accountant, company secretaries, and lawyers, all of them together. So we are a full-size firm in that sense also. And competition law is something which is my passion, I would say, for the last so many years. I was a part of the Competition Commission also. And I've been fortunate enough to be involved in the major litigations which are well known, whether it relates to abuse of dominance. I was representing National Stock Exchange, and I represent the State Authority of India in the sale case versus Jindal, etc. in the initial days. And so we've actually specialized in cartelizations, cases of cartels, etc., abuse of dominance, and mergers and acquisitions as well. We have handled some large mergers, so to say. For example, recent one we did, this Patanjali Ruchi Soya merger. This was it was a Form 2 case of type of a case. And so M&A is basically how the competition law comes into the picture. And as far as M&As are concerned, is that when we are talking of large size mergers, only when the acquisitions are large size, more than 2,000 crore of assets or 6,000 crores of turnover, combined size of the parties, when they are reach that threshold, then the Competition Commission's approval triggers it. But why recently this has become important is because of the insolvency, which I'll deal with later also, because of the distressed asset now being available for sale by larger companies. There the role of Competition Commission also comes. And Competition Commission of India is the first checkmark for any large corporate mergers approval to be taken. So we have actually some experience in M&As as well as antitrust litigation, but I basically primarily deal in antitrust litigations, and I'm an off-counsel also. I represent parties across the sectors. I mean, I don't want to name them because competition is a slightly sensitive subject. So, but I have got my clients all across the sector, including financial sector, including any sector you name it. I have had the last 40 years of my practice. So we will be actually happy. And I would like to inform the panel here that many a times it's so noticed that the corporates are unaware about the role of the Competition Commission, and they get caught, ignorance of law. So they go into the gun jumping, for example. Gun jumping is where you consume a transaction or you take a step toward the transaction without taking the prior approval. So I will, when I come to this, when my time comes, I'll tell you how important it is, how step by step you have to go by it. You just cannot consume a transaction. You cannot even do a transaction. You cannot even enter anything. You, for example, giving a notice also, etc., becomes a problematic to the SEBI and the takeover code, etc. So there are things which are very, very nuanced and which have to be understood very carefully. CCI is one of the penalties are huge. 1% of the turnover. You can understand Section 43A when the gun jumping happens. So the companies need to be sensitized about the importance of taking CCI's approval for prior to taking any step towards furtherance of the taking furtherance of the steps towards the merger. So that is my initial take. I'm ready to. I'll definitely be able to take you on further.
Thank you, sir. Thank you very much for giving the insights about the Competition Commission requirement for any M&A the country. So friends, so now this introduction round, or maybe the understanding the corporates requirement or whatever they are doing in their space. Now we like to understand, because you see, for success of any M&A, there are many ingredients which we need to check, or we need to adhere. Because without that, there might be challenges in the future, whatever the M&A transaction. I would like to come to again to Mr. Vikas Agrawal. Like to understand, because many times we have seen the M&A transaction is taking too much time. So if you can give us the guidance, basically, that how we can work out the M&A transaction in a shorter period or shorter timelines without diluting the interest of both the parties. So if you can give some tricks or some, because you are the journey of almost 20 years into that space, and you have worked on both the sides, so it will be helpful to our audience. So over to you, Mr. Vikas.
So Ashish, actually, whatever time in a typical M&A transaction takes will take. But few key things which I always used to recommend my clients and now the other side, is of course, getting the house in order. That's a key requirement when you're going to either do a fundraise or M&A, and ensuring that there is a transparency. What generally happens in typical M&A process is that you just try to avoid pitfalls, assuming that the other guy will not know it. And a typical equity transactions, right? There is a lot of faith involved. If you kind of betray is not the right word, but if you just assume that the other guy will not know it, believe me, there are 99% probability that he'll come to know one way or the other. So basically two things. One is basically getting the house in order and giving the right amount of the information at the right time instead of hiding from the other side will be the two criteria to ensure the transaction moves at the right pace. That's the only mantra to get the transaction out here.
Okay, thank you so much for your guidance, sir. Then we have Vishnu Acharya ji. Vishnu ji, I think for any M&A transaction, how anybody can measure the success and failure of M&A? If you can give some tips to our audience, because many times people are saying that this M&A could not be successful or not successful, and someday we say that it's a very successful M&A. So if you can give tips for that, or you can give the guidance on that also.
Yeah, so look, I think typically any company that does M&A has a thesis, right, that they are kind of writing out, and has a hypothesis or a thesis with which they make an M&A bet. Usually, at least good companies who do M&A also have outline it in numerical terms. So typically, outline if there is an asset being purchased at $X, then what is really the rationale for making that acquisition? What is the outcomes? Those could be objective outcomes in terms of any kind of metrics, right? Revenue or new expansion or number of customers, whatever it is. And typically has a timeline also to it, right? And the timelines can move, but broadly there's an understanding that, hey, we're going after this outcome, and if we can make that happen, that's probably what you'd call a successful M&A, right? In most cases, M&As fail though, right? And I think typically it's fairly, it boils down to execution and culture and a bunch of other things that kind of come all together pre and post doing the transaction. And I think there is other tactical ways to measure it. For example, we measure employee NPS as a alternate metric beyond acquisition outcomes to see if it was a successful one or not, because we typically think of how happy or upset our folks who partnered with us, joined our larger organization, and have been integrated within, right? And we track that, for quarters, at least for first 18 months post M&A. But beyond that, I think it's largely you seeing how much of your thesis has played out, right? And often, even if it takes longer, even if it's 80% of it, that's fine. But I think the bad outcome is when none of it plays out, and that happens quite often as well. So that's at least my 2 cents on how to think of successful M&As or success criteria and failure criteria for M&As.
Okay, great. Thank you so much. I think you have given one good point that you measure from the employee's point of view for next 18 months. So that's a good thing which you have given to us. So friends, I think for any transaction, the financial transaction, this valuation is the major aspect or the most important aspect also. So we would like to understand from Vikas Dugarji, whenever you are doing any M&A transaction, not only from Cipla point of view, as a practitioner, you like to understand because you are a banker also. In case of any private equity transaction or any M&A transaction, how do you value these transactions whenever you are taking control? So is there any premium which is giving on the M&A transaction, or there is a discount on that? So from the valuation point of view, if you can cover up in a detailed manner, because most of the people who are here, they would like to know whenever you are doing any M&A, how you value these transactions. So it will be helpful.
Sure. Look, when in a M&A, you are acquiring a asset, and most of the time the valuation has to be done on a financial metrics. And usually, if you look at the standard ones are there, the DCF and comparable transaction trading multiples. So I think everyone, when they go for M&A, uses one or more of these methods to value something. Now it's more a question about how do you, which one of them do you put more weightage on? And in my individual view, when you are valuing an asset, one is, and all of these have their own pluses and minuses. If you look at comparable trading comps, you could end up paying a very high number if you are in a bull market versus a bear market or whatever a normal market. A DCF again has its own pluses and minuses, although it will not lead you to the fallacy of the bull and of the bear market as the trading comps. But again, DCF are based on forecast, and forecast can go wrong. And in most of the cases, beyond 3 to 5 years, it's very difficult to forecast anything, even to the accuracy of 80, 90 or 70%. So each one of them have pluses and minuses, but when I usually do it, I use all the methods and try to see if it is making sense from all these angles, various angles. And apart from that, a lot of operational matrices have to be seen. I can give you example like whenever we look at a retail asset, something like a sales per square feet, or when you look at a hospital asset, maybe utilization or average length of stay, or kind of revenue per bed per day, those kind of matrices have to be seen ultimately. And beyond the financial matrices, I would say a lot of qualitative things have to be seen. It's not just pure financial matrices. Otherwise, the AI or the computer could have done valuation. You don't require people to do it. So as a lot of qualitative, on the qualitative side, I think what you are acquiring basically, and most of the time the acquisition is for an asset which will generate revenue or reduce cost in your system, or will help you to expand it to new geographies or new distribution channels, or will get you some kind of IP which will be either a technical or a software IP in your system. So each one of them, you have to see what are the various qualitative elements in each of them, and then kind of put a value. Many times you might end up having a brand which doesn't have that kind of revenue, but a lot of money has gone into building that brand, and that brand is very well known. So if you end up putting a financial metrics on revenue or EBITDA, you may not come to a number which is the true value. So I would say all these factors have to be kept in mind before you value an asset for various reasons. Now, coming to the question of control, premium, or discount, look, usually in a M&A, there are two things. One is control, premium, whatever. That is more relevant when things are listed, because you know already there is a listed market cap and you need to pay something more. And then in an unlisted world, again, there is a fair bit of control premium applicable, roughly, I would say 5 to 10, 15%, depending on the need of the buyer and the seller who is stronger in that transaction. I have not seen kind of discounts, although separately for minority transaction, and most of the time M&A is for majority. So in a minority transaction, it's usual kind of valuation for a minority stake. People don't usually use the word discounts there. The other piece when people do M&A is and more so in a process which is highly competitive, is to see how much of the synergistic value do you want to pay to the seller ultimately. So you have a standalone value of an asset which is there for anyone to pay for, and then you have a value which is very unique to you acquiring that asset, like a very good fit within your business. The asset is filling your portfolio very well. There are large synergies when you acquire it. Now, question is, are you willing to share a part of those synergies with the seller? And many times, or people, when in a very highly competitive situation, people tend to share a part of it, but usually the rule there is that you share those upsides or synergies benefits over a period of time, so that whatever you have forecasted for the asset, as we discussed, the success of the M&A, you link it with the success. That okay, if the seller has forecasted something that these are going to the revenues, profits after 3 year, 5 year, you link those things, those payments with the actual achievements of those matrices. It de-risks the transaction significantly, and usually at Cipla, when we look at things, we tend to kind of put a very high weightage on payments which are linked to future milestones. It helps in de-risking the transaction. It helps in kind of it helps actually both the buyers and sellers ultimately at the end of the day. So these are some of the pointers what we usually use when we look for M&A or even minority investments.
Very well said, Vikasji. I think you have given us the secret of the transaction valuations also. So I think it will be helpful to our audience because you see, it is always important that whenever you are doing transaction, the interest should be protected of both the parties actually. So it should be a win-win kind of deal for everybody. So very well said, and I think it will be helpful to our audience. I think I would like to discuss with Vishnuji and Vikas Agrawalji also on this topic, because this is an important area of any deal. So if you want to cover up Vishnuji or Vikasji or your experience, or you want to add in that from the valuation point of view, that will be helpful for our audience.
Yeah, I can maybe chime in and hand it over to because I think honestly, most points have actually been covered from a structural standpoint. Maybe the only couple of things I'd add is maybe what we do at Razorpay. We actually, like Cipla, also do a lot of earnouts or incentive plans, or which are typically linked to milestones. And that's a bit of a sensitive one, right? Because you don't know how long you want the same management team, how well they do. But typically, we feel like a couple of years is good enough time to at least start with. And without those incentives, I think at least typical entrepreneurs who built the company, if they're the ones running it still, and you expect them to run it within the acquired group once the transaction is done, you still need to create strong incentives to align outcomes. So we do a lot of that as well, and I think it's really helped us. And yeah, I think in our case, out of all of the companies, only I think one company is such where the founders moved on. Otherwise, all of them founders are still with us, building within Razorpay their own independent chapters.
Okay, great. Vikasji,
I'll hand
Vikas
it to
Agarwal.
Vikas.
Yeah,
Yeah,
Vikas
thanks,
Agarwal.
Vishnu. Thanks, Ashish.
Yeah.
So what we've been doing is we've done two large acquisitions. One was the RDC. Of course, over there we acquired 100%. But after acquisition, we actually went ahead and gave ESOP to the existing management team. Believe me, that was really helpful. Within 2.5 years of acquisition, we've grown the business 3x in all parameters. So the incentive culture, in terms of the ESOP, has really helped us, at least in the RDC. And so as in case of the Shalimar, here was a brand which was there in 120 years of existence. And we've kind of revamped the entire team, including brought the ESOP culture back. Flash forward today, a brand which was 350 crores in revenue we had acquired. It is grown 1.7x within 3 years again. So the incentive culture, be it in terms of ESOPs or the staggered equity exit, is the way to go about it.
Okay. Okay, got it. So I think almost from all the panel we see the incentive structures are helping, or scattered payment also are helping to basically get the valuation better also, and to keep the interest of both the parties in the deal for future also. So it's a good idea, I think, which has been come out from the discussion. So again, I will come to Mr. Sharma. So Sharma ji, if we see in Competition Commission of India, we are reading a lot of news articles on regular basis that this deal has been turned down, or this deal has been gone through. So there are many deals which could not be taken up positively, or which could not be completed because of the CCI which came in the picture. Can you just give some idea or some instances where the deal got rejected, or it could not be approved by the CCI, or what were the reasons for them? If you can, because you are having very good experience in that area, so it will be helpful to the audience.
Thank you, Mr. Agarwal, once again. Now, let me tell you, it is not that the CCI actually has been a very, very friendly regulator as far as the M&As are concerned. Very, very business friendly. And I'm happy to inform you that none of the deals, none of the transactions which went to the CCI have been rejected. They have provided modifications, they have provided remedies, but they have not rejected any deals since 2011 so far. There have been about 10 deals, very large-sized deals, for example, Sun Pharma and Bexy, Holcim Lafarge, those kind of deals, where the divestments were ordered. So it is not that the CCI rejects those deals. CCI tries to ask the parties to first voluntarily give the modification which they can make where there are overlaps. For example, just to give an example, suppose two cement companies are trying to merge. They wanted to merge. So Ambuja wants to merge, say, for example, with Dalmi, or with, say, JP, for example, just for example. And they are present, say, in Central India. They are also present in North India, but they're not present in South India. So wherever there are huge overlaps, so they will see the market shares first, and then they want them to divest and to find out independent buyers. The purpose of competition law is to see that the competition remains there in the market, not that the single firm dominance should not happen. So CCI, number one, does not reject deals. It tries to modify the deals to the extent, because they know that mergers and acquisitions are actually the way of growth. So that first impression I want to remove from the mind of everybody, that CCI has rejected any deal. Till date, CCI has not rejected any deal so far. And I can give you the number of 10 deals which CCI sort of suggested the modifications. And they are very, very, you can count on numbers. Yeah. I said about Sun Pharma and Bexy, and then Holcim Lafarge, and then Bayer Monsanto, very, very big international merger took place, Bayer Monsanto. And then we had Agrium Potash, and this was German company's merger. FCM Corporation, DuPont, and Dow Chemicals, PVR and DLF. DLF acquired the utilities of PVR cinemas, China National Agro Corporation, Syngenta, and then Abbott Laboratories. So there are 10, you can count on them. There are just 10 deals, or Holcim Lafarge, of course, I mentioned. So in all these deals, what the CCI did was they went for a phase 2 investigation. Let me explain how it happens. So in Competition Commission, what happens is, first of all, they try to clear the merger at the phase 1 stage itself. What is phase 1? Phase 1 is where there is not chances of any competition concern arising at all. There is not going to be any appreciable adverse effect on competition. So they try to clear the deal within 30 days. That is phase 1. 90% of the deals, or rather 95% of the deals, have been cleared at phase 1 stage, provided the filings are accurate, provided the forms have been accurately filed. There are no defects in the forms. So CCI has a very, very methodical process. They have come out with schedules. There is a schedule 1 to the combination regulations. So first of all, what is a combination? A combination is where the combined assets, it's asset and threshold, the two thresholds. So assets, 2,000 crore combined assets in India, or turnover more than 6,000 crore. And if it's a worldwide deal, 8,000 crore of assets in India, or 24,000 crore of turnover in India. So in India, with the largest thresholds in the world, because we have deliberately, India has kept the threshold the largest, so that the smaller deals don't get stuck. Smaller deals don't get stuck. So the deals of this size only will come, and mostly will be by MNCs. And there was a reason for it. So when the foreign companies started coming to India, when the liberalization took place in 1991, we never wanted that. You see, the Indian companies have to take approval when they go abroad. So ArcelorMittal, when it went abroad, it had to take approval of everybody. Or say Birla goes everywhere, they have to take approval from every company's authority. But in India, there was no such mechanism. So that's why this was brought in. Though this was resisted when I was in the CCI, I remember senior functionaries, even I would not name Mr. Tata, walking out and say, what are you doing? Getting another Inspector Raj. But it's not so. The time has proved that the Competition Commission actually has been a friendly regulator in this sense. And the combination, so as I told you, thresholds are there, then there are exemptions also. Target exemption is there, for example. So if a large company wants to acquire a small size unit, suppose in a hospital, so if the asset of that hospital of this unit is less than 350 crores, then it need not file. Or the turnover of the business is less than 1,000 crore, it need not file. So there's a de minimis exemption also granted. And then there is Schedule 1 exemption. For example, you are acquiring some voting rights or stakes, or shares in an ordinary course of business. And there's a minority investment is there, for example. There's a very good company, you want to invest in that company. And if the investment is less than 10%, or now, of course, it will be increased to 25% even. So you need not go to the CCI. So Schedule 1 of the combination regulations gives out 10 categories which are exempted. So those have to be ordinary course of business, stock in trade, etc., in which the control doesn't change. The key in Competition Commission approval is whether the control changes or not. So if you suppose, for example, a PE fund, private investment fund, maximum deals have been done by PE funds. PE fund, they acquire stakes in India. So if they are putting a board of director, then certainly they have to go to CCI. So the intention is, if the intention is to acquire any kind of control which is more than an affirmative right of an ordinary shareholder, you have to go to the CCI. So the control becomes important criteria. And apart from the control, as I said, the threshold is there, and the competition overlap, how much the overlap is there. So if the overlap is minimal, then the CCI will not interfere. But if the overlap is huge, if you are present, suppose there's a horizontal merger between two competitors. There are vertical mergers also. There are conglomerate mergers also. So to ease that, they have now come out with a green channel also, for example. A green channel has been introduced, in which automatic approval is granted. And green channel, if you have no horizontal overlap, you have no vertical overlap, and if there is no complementary overlap also. You understand complementary? Suppose a producer of a gun and a bullet, or a printer and a cartridge. So that is complementary, because that goes with it. So those kind of things, if they are not there, the day you file the notice, it is deemed to be approved. Automatic approval has been started in recently 2023 only. And now the amendment has come place. They are going to introduce deal value threshold also. That is to take care of the large, acquisition by Googles and all those multi-size, big size digital market giants. Well, what used to happen, they never had an asset in India. But they were acquiring. WhatsApp was acquired by Facebook. But no filing was there in India because there was no real value thresholds. 19 billion deal was there. but they never file in CCI. But now to capture those big deals by the digital giants in the world, the CCI is introducing a deal value threshold also. And the size is 2,000 crore minimum, same as the target minimum, de minimis size. So they have not kept it disproportionate. So they've kept it proportionate to the target exemption, which is already there. So, I mean, to answer your question, CCI is actually very helpful. There is a pre-filing consultation also provided. You can go to them, you can see consultation if you have a doubt, apart from, of course, to come to lawyers like us. You can go straight to the CCI. You can file a notice and say, we want to know whether we have to come to you or not. Because unfortunately, in India, there is no advance ruling. There's nothing like advance ruling that you don't go and, so to avoid that kind of thing, they give consultation. Whether you will need to come to them or not, whether it qualifies to file a notice or not. Even after, suppose, for example, within a group, there is a scheduled exemption, they call, if there is an exemption taking place within the group, where 50% of the rights are already held by the enterprise, then you don't need to go to CCI because it's a within intra-group transaction. So then, provided the control doesn't change from joint to sole, the only, as I said, the point to be noted here is the control, change of control. If control doesn't change, you don't have to bother about CCI because the filing fees are very huge. 20 lakhs for a Form 1 and 65 lakh for Form 2. You know, so and the criteria has been provided in the regulation. What is Form 1, what is Form 2, where your percentage of overlap is more than 25% horizontally or 15% horizontally or 25% vertically, then you have to go to Form 2. So Form 1 and Form 2 are actually have been already prescribed by the regulations. So there's a very elaborate, detailed, you see, legislation already existing in India on this aspect. There is nothing left for imagination. So we are always there to help people who are wanting to do such big transactions and also exemptions, whether they're applicable or not. For example, advisory also. You need to know whether we have to go to CCI or not because the target size is less. Certainly, you can come to get a PFC done. Pre-filing consultation can be done. So, in my view, Competition Commission of India has not proved to be a hurdle in the M&A's growth, you see, in India. And that is a very good picture which I see.
Very good message, sir. I think I can see your passion also because you are practitioner in this space. So you have given a lot of information which will be helpful.
No, because sir, why I'm saying so, Mr. Agarwal, I would like to add that initially during the initial phase from 2011 to 2000, at least 16, 17, there were many cases of gun jumping. Large companies like Tata's paid huge fines because they did not know whether they can consume transaction or not. I give you one simple example. In a particular, I'll not date a company. A company acquired, for example, Reliance acquired Binani. You know, that case was very famous, Amazon case, Amazon versus Reliance case. You may all be remembering that. In that case, the only thing they paid 15 lakh as an advance towards the deal. That was considered as a consummation of the transaction. CCI imposed fine. You cannot take a step, any step, even if it is to be recoverable later on. Suppose your share of purchase holder agreement says that we will take approval of CCI, but we'll pay toward consideration some amount. So even the payment of that amount was considered as consuming the transaction. So I mean, initially they were very, very strong. But lately what has happened is even the 30 days limit has also been removed. Earlier, there was a requirement of filing notice within 30 days of executing a binding document between the parties. Now that 30 days limit also has been removed. But you have to give to the notice before the transaction actually is consumed. That also I must clarify.
Okay. Thank you, sir. Thank you very much. I think a lot of things you have told us. And these things will be helpful also. I believe, I think everybody will get the benefit of it also. So friends, I think the one more I think question is coming from the audience basically. This question is very relevant in the current scenario that what we are seeing or what we have seen in the past, many startups who are flooded with the funds, they have done the transaction at very higher valuations. And I think these transactions are already in the public domain. So I would like to just understand from our veteran speakers that if this strategy is right, because there are certain successes are there, certain failures are there. And whenever we are talking to anybody, the benchmarks are set that this transaction has been done at this price. So my valuation will be better than this also. So if you want to comment on it, your personal comment or whatever your official capacity you want to comment, I think it will be good. So our audience will get to know what is happening in the industry, whether it is the right track or what will be the impact of it. So over to you, Vikas ji, Vikas Dugar ji, Vikas Agrawal ji, and Vishnu ji. If you can want to cover it, it will be helpful.
Maybe Vikas and
So
Vishnu, you want to go first? Yeah.
Sure. Ashiti, I don't think so that the startups have actually overpaid. They were, of course, they were flush with funds. There's no second thought on that. But let's look this way around. Those monies, they've received the funds came at at an extremely high valuation, and the business was supposed to catch up that valuation. Will they be able to catch that organically? The answer was clearly no. The only option those the startups had was to do inorganic. Was that valuation right, wrong? It is a function of which company are you looking at. In the consumer space, I would say definitely there was a lot of froth, which has now kind of settled down. So as to a large extent in the case of ad tech. But barring that, my personal view is that all those acquisitions done by startups in a long-term horizon, if you look at those valuations can be justified.
okay. Great. Good, I think, feedback which you have given. It will be helpful also. So Vikas Dugar ji would like to comment on it, or Vishnu ji, any views on that?
Yeah, I can maybe share a couple of my thoughts, right? Look, I think valuation is a bit of an art and bit of a science, right? And I think it has to be a healthy mix of both at all points in time. But I think it's always influenced by macros, right? It's not really something that is only defined by micros. So if you think of it, across the last 3 years at least, or even if the last 20, 30 years, it's always been cycles, right? There was the dot-com bust, then there was a little bit, of dips in 2015. And now we're seeing obviously another down cycle a little bit in terms of the way interest rates have influenced, just ease of raising capital for pretty much everyone and then deploying it and then the return profile expected from capital, right? In terms of both time horizons in these risky assets as well as, the expectation, absolute expectation itself in terms of returns. And all of that kind of governs how, individuals would value assets when they're acquiring it, right? So I think if you're looking at last 3 years, I think there was a reason for maybe some of those valuations to be higher. Just the way you were thinking of equity valuations is different for a lot of other macro reasons, and because of that, I think one could use those higher valuations to raise money, invest that inorganically, and I think the market is to some extent corrected itself right in this cycle. So I think and these will keep happening. So I guess hopefully all the guys out there sitting with money making the acquisitions are doing the right thing at that point in time and should be able to justify in some sense the valuation. So I don't think there is a macro trend where I think there is high valuations per se, at least in terms of M&A. In terms of fundraising, of course, and that's has its own reasons.
Okay, great.
I think, yeah, I would echo both Vikas and Vishnu on this. I think, look, one is we are talking about startups, they paying, but it could happen to anyone actually. And it's just a function of the environment and the market at which the things were acquired. So I would say people would have acquired a listed company which was at the peak and then it corrected, or for that matter, a startup acquiring a unlisted another startup. I think both are a function of the time and the environment. The only I would say the thing is that any startup who would have paid cash in a frothy market versus who has paid its own kind of stock, I think the second scenario is much more beneficial. If there's a correction in the acquirer's kind of valuation, then everything is all kind of corrected itself. So many deals, at least what I could observe, were not really pure cash deals, although they happened at a very high valuation. They were in a stock deal where the acquirer itself was valued at a crazy number. Now both have corrected, so that's fine. I think it has led to similar dilution to acquirers kind of shareholders. Hasn't hurt much anyone. But I think it's a function of, and it will keep happening in cycles going forward. So it's nothing new. It will happen in different spaces, different geographies, different sectors as well going forward.
Okay, great. So I think all of you are giving that feedback that it's not like that startups are doing very valuations at very high, then they're taking up the assets. So good, I think there's a good feedback which we got. So the last, I think the last question or maybe the last feedback from all of you. So there are three ways of doing the transactions, either the merger or acquisitions or the slump sale. So if you, all of you, if you can give in one line this answer, which is better actually? Will it be possible? First of all, because it's something which I'm trying to cover up whenever you are doing any deal, so the merger is better or the acquisition is better or the slump sale is better actually. So if you can give the answer in one line, will be better actually.
So there is no correct answer to it. It's a function of what are you looking at. Purely from the ease of transaction headache, of course, the slump sale is the best option. But you will never be able to do a slump sale because every transaction or every option, slump sale, merger, acquisition has directly, indirectly taxation angle to it. So it's not that simple answer to pick one.
Okay, great. Anybody else would like
Yeah,
to?
one line answer, I think the same, right? It's all about deal context. Anything that context will define what ends up being the right decision for that deal.
Okay.
I think
Sir,
the same view here. Look, it also depends on the acquirer shareholders. Ultimately, I can talk about, say, some of the pharma companies. There, the founders are really kind of sensitive to their dilution. They don't want to give stock, reduce their stake in the company. So the merger is, or whatever, the stock deal is never on the table in certain cases. Versus a startup which is PE funded, several PE firms, and acquiring other startups. Some of them are common. Many times the usual kind of choice is to merge and make a combined cap table. So it depends on situation to situation as well. Within slump sale, asset acquisition, usually what we end up also is many times in diligence is people tend to get some kind of negative flags, at least with the entity. They don't want to kind of take up any risk of past liabilities coming from the entity, any income tax liabilities. Although things are covered through indemnities and whatever some of those reps and warranties, but usually the general market, they think that an asset purchase is slightly safer from a liability perspective. You actually don't end up taking past liabilities versus acquiring an entity itself and then slightly higher risk. I think from a taxation point of view, income tax merger seems to be the most efficient. In fact, all three are efficient, but merger is slightly easier to kind of take it through the income tax returns. Today, again, if you look at slump sale versus asset purchase, again, there is the GST angle. Still, there are gray areas there. People are figuring out whether there is actual GST on a asset purchase. So some of the companies, they don't want to go for asset purchase just because of the GST angle. It adds up to the kind of there is a input tax credit which you need to be sure of taking in the purchaser's book. Many times the income tax is higher when you end up doing asset purchase versus a slump sale. So depends on situation to situation. Each situation is different actually.
great. Thank you so much, Vikasji. I think you're very well covered also. So Sharmaji, I think not last, but not least, I think your views are also important as a lawyer. Although it cannot be a straight answer, I think everybody is right. But if you can give a short answer of it. I think you are on mute, Sharmaji.
For me, there's no difference between a slump sale or a sale or acquisition of ongoing, concern, etc. This because if the targets are met, thresholds are met, the notice is required to be filed. Notifiable to be seen with respect to the threshold which I just stated, told you. You can keep it in blocks. People don't buy the target, keeping the target size in mind of 350 crore assets. People buy in pockets, they do like this, so that they can break it up. So the notifiability is removed. CCI, you don't have to go to CCI. But one thing I'd like to tell you now, something recently which is happening since the IBC came. I think none of them have mentioned about this. There are a lot of distressed assets, lying around, which are actually good assets, and which are available in the market because the companies have gone under the resolution process, CIRP. So those assets are most of the companies are buying, and when those purchases are made, then you see you're required to go to the you may require to go to the Competition Commission if the size is more than 350 crore. And here is one important legal point which I'd like to mention for everybody's knowledge is till 2018 there was no amendment in the law, so it was not clear whether a company who's buying an asset, whether it has to go to the take approval of the Competition Commission before or after the COC's approval, of the resolution plan. But now it has been clarified under the amendment of the insolvency, the section 31(4), which says that if it is a combination, if a resolution plan qualifies as a combination, then the approval of the Competition Commission is mandatory. So that clarity has come. In fact, in this context, I can just share screen one of my articles I wrote in the Business Standard in 2018. It was in this context only when Binani Cement was being taken. The tussle to take over Binani Cement was between Dalmia Cement and Ultratech. So that time, this problem came, but that time this amendment had not come. So the Dalmia actually took the approval as an amended caution, and their plan was qualified before the COC. But Ultratech did not go for it because there was no clarity. They say we'll go if our plan succeeds, then only we'll go to the CCI. Why should we go in the beginning? So that this I actually clarified in this article in 2018. So that also must be kept in mind that if the asset size is breaching the threshold of 350 crore, be very careful that you may require to go to CCI.
Thank you,
sir. For me,
thank you very much.
slum sale and they don't make a difference.
Okay, got it. So friends, I would like to end this session here because we already crossed our time limit. It was a very interactive session, I believe, and our audience who have joined us from different part of the country, they must have the more knowledge about the M&A side. Our speakers, our panelists have given their views on that, on the various aspects of M&A. And I would like to just tell you that we got more than 750 registrations, and I've been told on the various social media platform and the Zoom, I think almost 300 people have already joined on this. And this will be available, this video of this program will be available on YouTube. So anybody would like to pass on to their friends or they want to see it again, they can go through it. And now I would like to thank you to all the panel, Vikas Dugarji, Vikas Agrawalji, Vishnu Acharya-ji, and the Advocate M.M. Sharma-ji for joining with us and giving their time, valuable time to us for this webinar. And we are very delighted. And I would like to thank you to all of you once again. I would like to thank you to all the audience, people who have joined us. And I would like to thank you the Resurgent India team who had worked hard to make this successful. They brought all of us at one place and we could discuss the nitty-gritty of the M&A. So thank you once again to all of you and I wish you all the best. Thank you.
Thank you, Mr. Agarwal.
Thank you.
Thank you, everyone.
Thank you.
Thank you for having us.
Thank you.
Thank you. Bye-bye.